Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1153A, and today's date is December 15th, 2016, and the title of the episode is The Fed Wants Banks to Pay $2 billion more a year to prop up the system against a market collapse. Let's get into the economic collapse financial news. Now, today we see, after the Fed made their announcement that they're raising interest rates by 25 basis points, we see the market continually moving up. They want to hit that 20,000. And on the flip side, we see that gold is suppressed even further. And then when we take a closer look at what happened with gold, we see something very interesting. Someone dumped over 10 billion in notional gold through the futures market. Over 90,000 contracts were dumped through the futures in the brief time after the rate hike decision, to show everyone that this was the right decision, that the economy is improving. You don't need to buy gold and silver. By the way, gold and silver, it's on sale right now. Pick up as much as you possibly can. And we see it hit the gold market, it hit the silver market, and they came straight down. The central bankers, the elite, they don't want us having money outside of their system. They're trying to keep everyone's eyes on the stock market. In the meantime, things are falling apart. And they're falling apart rapidly. We see Freddie Mac. Well, Freddie just issued a warning. Now, why would they issue a warning right now? The real estate market's fantastic, isn't it? And what they're saying is that the real estate market and refis, well, they're about to get worse. The population of eligible refinance candidates has already plunged by more than half, and as Black Knight pointed out, at the end of November, there were still 2 million borrowers who could save about $200 a month by refinancing, a cumulative $1 billion a month in potential savings. This is less than half of the $2.1 billion a month available just 4 weeks ago. Since then, the number has shrunk substantially as rates continually move up. Freddie, their explicit warning, says that if rates continue their upward trend, expect mortgage activity to be significantly subdued in 2017. What are they saying? Real estate is going to slow. It's going to decline. And if you don't have the buyers, what happens to the prices? They start falling rapidly. Unless they're continually manipulated by the Fed. But they can't manipulate everything. This is why we see the 20 cities that they can manipulate. And everything outside of that, prices are coming down. I just trekked across the country. They are dropping quite a bit. There's no traffic to these homes. Now, as the Dow is soaring to all-time new highs, homebuilder confidence surges. Now, this is kind of strange because interest rates are going up, mortgage applications, they're continually declining. Freddie Mac just put out a warning, and homebuilder confidence explodes to its highest since 2005. Of course, we know what happened in 2007 and 8. Real estate collapsed. Well, that's what's going to happen now. Remember, most of this stuff that the corporate media is putting out there about confidence levels and things like that, it's completely made up. Take, for example, U.S. manufacturing PMI, the survey. Well, U.S. manufacturing PMI, they're telling us that it hit all-time new highs. It's doing fantastic. But it's entirely decoupled from industrial production. And export sales, well, they've completely stagnated. So what do you believe? The soft survey data or hard, real data. I'm going to go with the hard, real data. I'm going to say, okay, the survey was completely manipulated to make things look good. Just like, the unemployment, just like GDP, just like the stock market. You start to see a common thread through all of this, where the central bank, the U.S. government, wherever they can manipulate, they do it. But the hard facts contradict everything that they're manipulating, which is kind of strange. Even the Philly and the Empire Fed surveys, well, they surged once again. Now, we've seen this before. If we go back in time, we've seen the Philly and the Empire Fed, they surged right before the collapse in 2008. They want everyone to believe that everything is doing fine. And when you look at the Empire Fed and the Philly Fed, labor market conditions, they remain weak. Manufacturings are reporting declines in employment and hours worked. Inventories continue to fall. So we have some problems here. The data is not matching up. And, you hear the government out there, they're saying that, tax receipts are at all-time new highs. But you need to break this down because they're telling us the revenue coming in. Remember, they enacted 2 laws, FATCA and GATCA, where they go across the globe and they tax those people who were never taxed before, who have funds in other countries. But when you look at the real revenue coming in from the workforce here in the United States, it has been declining, not increasing. And we've discussed that in earlier reports. Even when we go from state to state, we also see those revenues decline. So it's a play on words in what they do here. And it sounds great until you weed through all the data and you say, well, wait a minute. I see what they just did. Since those 2 laws, they went around the globe and they included all that and saying, wow, look at this. Everyone's working. But if you remove those individuals and you look at the people who are actually working and what they're contributing, guess what? It's not. The revenues aren't there. It's not working. How can it be? Think about it. If people are losing their full-time jobs, people are falling off the job market, people are getting part-time jobs, people are making less money, wages and salaries are going down. That means less taxes. So what the government is trying to convince us of and what the central bank is trying to convince us of, it makes no sense. Now, something very interesting happened. The Fed came out and has said the largest U.S. banks will have to pay as much as $2 billion more a year to insure against a future market collapse. Now, that's very interesting in itself. A future market collapse, they need more funds. They outlined a new rule designed to further protect the financial system. Do you really think it's protecting the financial system? No. This system is planned to come down. And what they're saying here is the rules demand Wall Street holds more debt that could be converted to shareholder equity if a bank is pushed into bankruptcy. Investor-owned stock is the main buffer against failure. Then they move to depositors. They do the bail-ins. You see how this is playing out here. And something else that's very interesting is that the Fed officials, they've declined to identify the 4 banks that lack sufficient debt under TLAC. So this is very interesting that they don't want to identify or reveal these institutions. Now we know many of these banks, they're insolvent. Many of these banks, as we know, do not have cash on hand. And we know the stress test, it's a propaganda piece to make everyone feel good that the banks are doing well. They put this into place after 2008 to make everyone think that, look, we're doing these hard tests to make sure that these banks are okay. We know that's fake, phony, and false. And what is happening here is they're propping up the banking system. They're not protecting the people. They're not protecting anything else except themselves. We see the war on cash is escalating. We know that Australia is proposing the ban on the $100 bill. We see what's happening in India. We see what's happening in Venezuela. And we see right now that Australian citizens, well, it looks like they're the next victims. AU News reports government floats $100 note removal. There are currently 300 million 100 notes in circulation, and 92% of all currency by value is in 50s and $100 notes. A report by the UBS recommended that Australia scrap the $100 note. According to UBS, benefits may include, and of course this is the propaganda piece, reduce crime, increase tax revenue, and reduce welfare fraud. But from the bank's perspective, they're looking for an increase in deposits because they want everyone with the $100 bill to come in and deposit their money. They're hoping that no one takes it out. They just, okay, here you go. I had this under my mattress. Thank you very much. Well, we can see right now they're removing cash. They're propping up the banks. And when we look at different countries, we see that Australia, the popularity of payment methods, well, it's cash by about 65%. Debit cards are around 20%, and credit cards are around 10%. Here in the United States, cash payments are only around 45%, while debit cards are around 25%, credit cards are around 20%. And we can see right now that they are trying to get rid of cash and switch everyone over to using debit and credit. And we know this is part of their plan. They want the cash inside of the banks. Makes it much easier to do a bail-in. This way, you can't take anything out if there is no cash. But they know it's going to take a certain period of time to do this, so it's easier to say, listen, just bring in your currency, put it into the bank, everything is fine. And they have your currency hostage right now. Now, there's a dire warning coming out of Goldman Sachs, and they're saying the third wave of the global collapse is coming. The wave is characterized by rock-bottom commodity prices, stalling growth in China, and other emerging market economies. They're also saying there's going to be low global inflation. And right now, the triple whammy has its roots in the response to the first two waves of the crisis: the banking collapse, the European sovereign debt crisis, and it is all part of the so-called debt supercycle of the past few decades. And the problem is that in many states, there's a lot more takers than makers. And when this collapse hits, it's going to be horrific in some of these states, like California. They have a powerful economy with 14 million private sector jobs. It also has burdens. Welfare recipients, 12.6 million. Paid government employees, 2.1 million. People collecting government pensions, 1.3 million. Add the numbers up. There are 114 clients drawing from the government for every 100 people, chipping in by working outside the government and paying taxes. We're calling this the feed me ratio. 6 states have a number over 100. Now, these states are at risk of going into a downward spiral in the next recession. The burdens will remain, but too many of the providers, employers in the private sector might shrink and completely disappear. So, here are the states: New Mexico, 148 dependents per 100 private sector workers. West Virginia, 116 dependents per 100. California, 114 per 100. Mississippi, 111 per 100. New York, 108 per 100. Arkansas, 103 per 100. Which means in these states, when things go downhill, we're going to see violence, crime, looting, riots, and it's going to be a huge problem, especially when the ATMs, EBT cards, everything stops working. It's going to be a nightmare in those areas. Doug Casey believes we're headed for what he calls a super depression, created by the ending of a debt supercycle. When this depression, which has already started, gets momentum, it will overwhelm the plans of society that is expecting to get things like Social Security, pensions, payouts from retirement plans they have paid into for many years. All of those things will disappear almost overnight and leave society gasping and stupefied over what to do. And this is why all along I've been saying everyone needs to be ready and prepared. Food, water, protect your wealth. But you need to be prepared and ready. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.